Fed's next move looms after September rate cut as markets weigh softening jobs and sticky prices. Headline: Fed's next move looms after September rate cut as markets weigh softening jobs and sticky prices. After its first rate cut of 2025 on September 17, lowering the federal funds target range to 4.00 to 4.25%, the Federal Reserve heads into its late October meeting with investors parsing every data point for hints of the path ahead. Chair Jerome Powell framed the September move as risk management, noting moderating growth and slower job gains even as inflation remains somewhat elevated. The implementation note also reduced the rate paid on reserve balances to 4.15%. Markets now debate whether a follow-up cut is warranted, given cooling labor indicators versus tariff-related price pressures that could keep inflation sticky into year-end. Analysts point to the summary of economic projections showing a cautious tilt toward additional easing, though the committee remains split on pace and magnitude. Notably, newly appointed Governor Stephen Miran dissented in September in favor of a larger 50 basis point reduction, underscoring the policy divide. Mortgage and credit markets have already responded to the September decision, with affordability metrics edging slightly better but still tight by historical standards. For households and firms, the question is less about one more cut and more about the trajectory into 2026. How quickly borrowing costs normalize without reigniting inflation. With political noise high and global growth cooling, the Fed's communication next week may matter as much as the decision itself.